your beacon score, your credit rating, and how they are affected by COVID. And just wanting to make sure that you understand how they work in general. If you have been using any of the deferrals, so to a financial planner, the word deferral is a 4-letter word. I know, it has a lot more letters in it than 4. In fact, it is a double 4-letter word with 8 letters. The reason for that is that any time that you have a deferral of your mortgage or of your credit cards, it affects your beacon score. I know you've heard that, none of this will affect your credit rating, none of anything that the government or your bank or anybody else is having for you as a help during this time will affect you. Well, that's not true. In fact, I had a discussion at the very beginning of COVID-19 lockdown in March with a very large credit card company and their issuing and credibility department. The vice president of public relations for new card holders, and they were very clear that not only were they already taking action to protect themselves against COVID-19 and the card users' use during COVID-19, but that they were doing everything right to and including canceling credit amounts, credit limits. So all of these things will affect you in one way or the other. If you miss a payment on a credit card as a rule, it will be very detrimental to your beacon score. Your beacon score is also known as a credit score. So your credit is broken down, and realistically it goes from about 300. If you're below 300, don't worry about it. You're never going anywhere with credit. You have to be above 300 to exist. But 300 to 1,000 is the number that is used to determine your beacon score. Every time you miss a payment, your beacon score will drop by a minimum of 50 points. If you go into arrears on a credit card or any other type of debt, and they take legal action, your credit score goes down by 100 points. Right now, most credit scores, which are considered good, are around 650. If your credit score is 650 or above, you're going to be fine. Everything is great. If it's 650 or below, you need to work on it, and you need to work on it now, because it's not going to get better with COVID. In fact, COVID is going to affect it dramatically. Now, a lot of people will say, what's the difference between your credit score if it's okay or good? Well, if you had a credit score of 710, you could get a mortgage for under 2%. So your mortgage interest rate would be less than 2% right now, if you're 710 plus. However, if you're 670 or lower, you're going to be looking at 5%. The 3% difference equals, we'll just do average, but depending upon the size of your mortgage, it can be $100,000 on an average mortgage in interest alone that you will pay extra because your credit score is 40 points lower. That is dramatic. That's like paying for your house and half over again, at least. Or if it's a high mortgage, even higher. So just dealing with that part alone, you want to make sure that your credit rating remains protected. If you defer your mortgage or you defer a credit card, make sure on the deferral dates when it has to be repaid that you are able to repay it. If you are not able to repay it, check into the terms and conditions very, very closely. If you have deferred a credit card, it has already affected your credit rating. Regardless of the amount, regardless of the credit card type, regardless of anything, if you have deferred a credit card payment, it will be detrimental to your credit rating. If you have deferred a mortgage, at no time does a mortgage or a utility bill affect your credit in a positive way. The only time a mortgage or a utility bill affects your credit at all is if you miss a payment, and then it's detrimental. If you are deferring your mortgage, that will show on your credit bureau. The banks are required to report your credit correctly. So the deferral will be showing, and that will cause your points to go down. If you can end your deferral or pay off your deferral or don't do the deferral in the first place, your financial records will be much better. At the same time, never, even if it's not COVID, never miss a minimum payment on your credit card. The other thing you want to do, and it's not as worrisome today as it used to be, but if you want to build your credit, you must have a credit card. There's almost no other way, either a credit card, a bank loan, or a car loan are the only ways you can build your credit rating. And the way you do that is to take the loan and make the payments on time every time. If we have actually seen people who have lived their entire lives, they're getting ready for retirement, they've owned a home, they've paid utilities, but their spouse did everything to do with credit. And in most cases, it's the lady of the household who finds herself without any credit at all because she never got any credit while she was married. Worst case scenario, she's getting ready to retire and her husband passes away. She may not even be able to maintain or remain in her home because she doesn't have any credit. She may not qualify for the mortgage if they haven't already paid it off. And very few people in Canada are properly insured to cover their mortgage, to cover their final expenses, and to take care of their family when they're not here. There is 3 things in life that we say are guaranteed. The first one is death, the second one is taxes, and the third one is you don't get to cash your life insurance check. Somebody you love does. So that check needs to be big enough to make sure that their future will be covered and be protected. All right? So if you need help with any of these things, you can contact our office. You can contact a trustee. Do not jump right now if for any reason you're in a position where you can't meet your expenses. One of the first things that a trustee will try to get you to do is file a consumer proposal. Take a look at the consumer proposal and the repercussions of a consumer proposal very carefully before jumping into a consumer proposal. The reason that everybody's trying to get you to do a consumer proposal rather than a bankruptcy is political and financial. Okay, the government wants as few people as possible to declare bankruptcy. If you declare a consumer proposal, you stay out of the statistic of bankruptcies. So the government pays a trustee for you to go through a consumer proposal rather than a bankruptcy. If you're in that situation, talk to a financial planner as well as a trustee, not just a trustee. Or give us a call, 647-403-5381, Waterson Financial.